Hi, it's John Kelly. In this module, we are going to discuss external confirmations, and in particular, the reliability of external confirmations. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, I get pushback on the reliability of confirmations when I tell people that accounts receivable confirmations are not reliable. And confirmations remain an auditor favorite. Auditors cheerfully send out lots of bank confirmations, lots of receivable confirmations. Now, I think it might be useful to think about where this perceived, at least, requirement came from. And it comes from the McKesson and Robbins swindle of 1938. And the judge said, you would have found the problem if you had confirmed accounts receivable. Or he said something like that. That's at least what the profession interpreted. And as a result, audit standards changed, and the perception was at least that confirmations were a required audit procedure. And I don't think that was ever actually true. Certainly it hasn't been true since 1980 or so, though that's how it has been reported, that this scandal caused standards to be changed to require accounts receivable confirmation, and that is not true. Now, the logic the judge used, and he wasn't an auditor, he was a judge, and he was probably correct that in that particular case, in that particular fraud, if the auditor had sent out receivable confirmations, they would have found the fraud. Now, perhaps in other circumstances, in other frauds, that procedure wouldn't have done it, and another one would have been required. The other thing, I guess, to remember was that in 1938, standards were such that the auditor had done absolutely no work on accounts receivable. So other procedures would have worked as well, subsequent payments, something like that. But it was true in that particular fact circumstance that confirmation would have found the problem. Now, the judge probably, if he'd been an auditor, would have been better if he had said the auditor should have tested existence of accounts receivable, and then left it to the auditor's judgment how the auditor got around to doing that. And he might have said, and you should test valuation and completeness and rights and obligations as well. Now, the other thing that happens when I ask auditors, they tell me that they think confirmations are great, and I then ask them, well, how often do they come back wrong? And the answer is, well, all the time. Bank confirmations all the time, receivables confirmations come back wrong all the time. And so then I say, well, they come back wrong all the time. Doesn't that tell you that they're not very good procedures and you shouldn't do them? But auditors persevere in sending them annually. Confirmations of receivables are also a bit of a time waster because we tend to get very poor response rates. And so last year, 3 of 30 confirmations came back, and we're planning this year's audit, and we go, oh, only 3 came back last year, but let's give it a try again because maybe all 30 will come back this year. Well, of course, only 3 come back. And further, fraudsters who all trained as auditors have now found really cool ways to fool auditors with both confirmations and testing of subsequent payments. Equity funding, national business systems, in both those cases, the client managed to find a way that they got signed confirmations back to the auditor on phony accounts receivable. And they even found ways to get phony subsequent payments made on the phony accounts receivable. So that's one of the reasons we really should be doing analytical procedures. In both those cases, analytical procedures would have found the fraud. Confirmation and subsequent payment did not, but analytical procedures, simple, easy to do procedures, would have found it almost right away. And that's also the other reason we want to be unpredictable. If the client is expecting us to send confirmations and planning to fool us that way, and we do the audit differently this year, perhaps we will uncover the fraud. Now, I have 2 stories to tell. A long time ago, I was doing an audit, large client with large suppliers. They were the customer. And as I walked by the controller's desk, he had a bunch of pieces of paper, and he was about to put them in the garbage can. And when he saw me walk by, he kind of went, oh, if you're here as the auditor, I guess I should probably not throw these away. I guess I'll just sign them. So he started signing them all. And I went, well, what are those pieces of paper? And he said, well, those are accounts receivable confirmations from some of our suppliers. And I went, you're just signing them without looking at them? And he said, well, yeah, if I don't sign them and mail them back, I'll get a second request, and that's annoying. And I normally just throw them away, but sometimes I just sign them to get them off my back. And I walked away and went, wow, we as auditors really depend on those confirmations as really good audit evidence. And if you're just signing them and looking at them without looking at them, then we've got a problem. Second situation, another large client of mine, manufacturer that sold stuff. And there were two receivable confirmations that arrived on the same day, and they were both for large amounts. I've kind of made up the amounts. I do remember one being $186,000. And one of them was signed off by the client as agreed. And my staff were getting ready to put that in the file. Oh, good, we got a confirmation response in agreement. That's great. And the second one, the customer had written close to within $1,000. And my staff said to me, well, we better throw that away, because that's not very good evidence, because they haven't agreed with it. They just said close to within $1,000. And I thought about it for a second, and I said, you know, this is a very large client, and these are two very large customers. And these two very large balances are made up of many, many small invoices, maybe 150, maybe 200 invoices. And there are shipments in transit, there are payments in transit, there are invoices in the mail, there are rebates to be paid, and there's absolutely no way that the customer could figure out the balance that they owe, because we didn't send a statement, we just sent a number. So there's really probably no way, without them doing a lot of work and us giving them a lot of information, that they could figure out and agree. And the conclusion I came to was that the first one that agreed couldn't possibly have looked at it. They must have just signed it without checking, like my former client, the other client I talked about. The second one, who said close to within $1,000, had at least looked at it. They'd at least thought about it and decided, well, you know, that's about the right number, so we'll help you out and tell you that's pretty darn close to being the right number. So, and we never got very many responses anyway. Sort of 2 was a big number, and throwing one of them away was painful. But anyway, it sort of pointed out to me that confirmations just really aren't or can't be reliable. Now, the research that was used to demonstrate the lack of reliability was a large, sophisticated, and real client. They were sending out real confirmations on a real client to real customers, and these were large, sophisticated customers with sophisticated accounting systems. The client was selling large steel beams and components for skyscrapers, so many of the accounts receivable balances were a single large invoice. So this should have been the most highly likely possible client situation where people could correctly confirm. And with the auditor's consent, they deliberately and individually materially misstated the confirmations. And they did overstatement and understatement, because the tradition is that confirmation replies with overstatement are more likely to be reported than understatement. And there was a slight but not significant, statistically significant difference. It didn't matter, overstated or understated. And what happened was 50% were returned, signed, and materially misstated. They had not been checked. Now, this study was done in 1990. It was probably about 10 years later that I was talking to an academic colleague of mine. I'd read this article, and I was puzzling about it. And I said to my colleague, I said, you know, I've just read this study that says that 50% of accounts receivable confirmations are returned without checking. I said, can that be true? And he said, no, it's not true. And I said, oh, thank goodness. And he said, later research, it's much worse than that. So at that point I gave up and said, okay, I have to accept that. I've seen it with my own eyes. Accounts receivable confirmation is not a reliable technique. And this is why that sentence went into professional standards. There is a risk, however, that a confirming party may reply to the confirmation request without verifying that the information is correct. And it's probably more than may, they probably do. And with pressure on staff and people doing more with less, The probability that accounting people in other people's accounting departments have the time to go through and reconcile up your confirmation request is declining rapidly. So in summary, we get few replies. It's not efficient. At the end of the audit, we're madly running around trying to clear the uncleared ones, so it wasn't a very smart procedure in the first place. It was inefficient. And they're not reliable, so it's ineffective. It ignores our audit strategy. It's ineffective. We're ignoring all of the other evidence we got from analytical procedures, from systems walkthroughs, from other procedures performed. We've ignored it all and tried to get it all with accounts receivable confirmation. And we're also probably auditing the wrong assertion. We're auditing existence when we probably should be worried about valuation. Now, if there's no other way to get audit evidence other than confirmation, I guess we're going to have to find a way to deal with reliability, though I'm not really sure what that might be. I guess perhaps we're going to make phone calls. We're going to have to find a senior person who we will be able to persuade to do enough work to actually check and make sure that the balance is correct. So, thanks for listening.